Well, thanks everyone for joining. Hopefully, energy there you can see me, and so I'm on YouTube Live right now, and streaming on Twitter Spaces as well. But today I wanted to review a company. It's called Athabasca Oil. The motivation really for me is that we just had Q3 earnings, and sometimes it's very difficult to sit on your chair and cover the companies and really understand what took place. So maybe I'll use this opportunity to go over some of the numbers, mostly kind of educate on the numbers and then educate myself and see what I'm missing and see through feedback and comments if people feel that they feel the same about the numbers or what they think about the strategy. So what I'm going to do first, I'm going to share here. And again, for those on Twitter Spaces, I'm going to be sharing right now the earnings for Athabasca and kind of go into details through the numbers. I think the first thing I want to share, though, is I have this slide that I share with the community when I go live on the Spaces, is that because we're talking about public companies, so the information I share is aggregated. So basically what I do, I'm not a financial advisor, I'm a professional engineer though, but I do aggregate data from the public domain, and this could be used for educational purposes only. And we're going to be seeing the production rates, we're going to be seeing some of the economics, some of the numbers they report. And so this should not be used as kind of investment advice, but it should not be also understood as investment advice or interpreted as investment advice. And everybody should do their own due diligence. But I feel like there's no such concept as like in-depth review of companies from just what they do fundamentally, like how much oil they flow, how much they get paid, how much netback. A lot of the stuff we see on social media is kind of like somebody's understanding whether this is good or something else is bad, or one versus another, where the goal here is really to kind of more to come from an educational point of view. Okay, so maybe I'll close this right now. And sorry guys, I'm in parallel, I'm also like sharing some slides here on YouTube Live. Share screen. Okay, so how I'm gonna pick now the earnings and gonna cover them in details. So Q3 final earnings on the website. All right, Q3. Yeah, okay, share. So right now, if you guys watching me on YouTube Live, you should be able to see the slides. And I'm gonna be going into the details here. I'll minimize myself first. And again, I know for Twitter Spaces, guys, it's a little bit different and kind of weird that I'm doing this simultaneously, but I think could be very helpful for people that are trying to understand what's going on. So essentially the company, and so what I'm going to do in this presentation and as part of this live, I already see I have about 11 people watching, so that's good. So we're going to go over the numbers, then I'm going to pull their presentation to see how the presentation aligns with the numbers for the quarter. And then we're going to be looking at their production rates for Leismer and Hangingstone mainly. Okay, so this company, right, Athabasca Oil, it's kind of like it's a company that has many different kind of interesting views. Some people think about this as this company that, used to exist back in the day where it was a highly levered, lots of debt, kind of very risky company. But reality is they evolved, and I think that's the value position. So if you look kind of what's been communicated on BNN Bloomberg and such, is that, for example, this is like a 9.9% holding for 9 Point. And some views were that it yields like the highest leverage to narrowing Canadian differential in oil price. It has 40 years of reserves. We're going to be seeing through the slides if that's the case. And it trades at 3 times cash flow. I think it's appropriate, but we're going to be looking at the actual numbers. The expectation is that it will return 75% of the free cash flow to investors, starting basically like right now as we speak. Some of the expected price on BNN was shared as being $6 per share, and the company is now debt free. It's not like really debt free. It has debt on the books, but it has like way more cash. And so if I was to kind of narrow to the numbers I wrote down here, and maybe correct me if I'm wrong and leave a comment for this quarter. So, and we're going to be looking more specifically as I share the slides. The free cash flow was 108 million for this quarter only, right? So that was like a really good quarter for them. And so the enterprise value is about 2.3 billion. So if you take, let's say, 108 billion, right, and you divide by that number times 4, assuming the same kind of quarterly earnings are every quarter, you will be seeing the basically the free cash flow yield. And so if I was just to kind of oversimplify and say, if Q3 was $100 million, and that would have happened like $108 million, and that would have happened like every time in the upcoming quarters, then they generate about 400 million in free cash flow yield in free cash flow. And if the enterprise value remains about 2.2, 2.3, that's around 16, 17% free cash flow yield. So the other angle here is that they actually have right now, so if they trade at $2.3 billion enterprise value, 2.3, 2.4 billion, they have about 337 million in cash, and they have about 212 million in debt. And so the net cash position is about $150 million based on their slide deck. And so we're going to be looking, but I feel like it's a little bit more dynamic. So whether they like reduce debt or buy back shares, so that money kind of moves 10 plus minus $20 million. So at the end of the day, they do have debt, so $212 million, but they also have cash, $337 million. And they did 380 million in sales. Their adjusted funds flow is about $141 million. And so you can start calculating adjusted funds flow is basically 141 minus 35 of sustaining capital, free cash flow yield 108, right? So, and they sold another like asset for 160 million. So if I'm looking at the slides right now, they basically kind of advocate themselves as part of the strategy right now. They have 2 thermal assets, right? So the first one is Leismer, which is their kind of jewel asset. The other one is Hangingstone. And they're looking at those assets as low decline production. And as I go and talk about this a little bit more, you will see the production that essentially does not decline on the curve. In the light oil, they made an interesting move this quarter. So they de-risked higher margin liquids and reach Kaybob and Duvernay development, but they did have other assets like more conventional assets, I think in the Montney, which they divested and basically they sold for $160 million. And so that's how they became to be at this really high cash position, plus they had cash before. And the financial stability right now, it's low leverage, flexible capital, prudent risk management. So I kind of agree with that. Now, the one thing I've heard, there was a visitor on BNN Bloomberg. I don't remember who it was, but he was saying, I think it was actually Alex Roos, and I kind of respect Alex Roos. And he was saying that the company was like close to bankruptcy 3 years ago, which is correct. And he also said that they made it around the corner and paid off the debt. So that's not really true because the debt is half paid, I guess. It's still kind of on the books, but they have a really huge cash position as well. And then he said, look, if it's a high cost producer, which I entirely disagree with, we're going to be looking at the numbers and seeing that it's not so. And he says if oil goes back to $40, which I'm not sure why that would happen, the stock is going way down. This could happen, for example, if China is in a huge recession. Great lever play. If you want leverage, you'll know oil. Okay, so that's kind of some different view on this company. So basically, they go and produce about 36,176 barrels per day, out of which 95% is liquids. And you guys, if you're not seeing me on YouTube Live, you can like really see those numbers that I share right now. I think it's going to be kind of easier for you to see. So in the sales, they sold petroleum, natural gas, midstream sales about $380 million, right? And so out of that, the free cash flow was 108 million, which is still really nice. Like as I said, if the company is like a $2 billion company, 2.2, 2.3, and they yield 100 million per quarter, based if the quarter we had, if it's representative as a representative quarter, then the yield here is closer to 20%. So operating income 168 million, operating netback. So that's an important one, right? So for a company that doesn't have to spend any money, the operating netback is about $50 per barrel. So $50.84. And the adjusted funds flow is 141, right? So you take the 35 million they spend additional on the sustaining kind of production, and you subtract from that 141 million, and you get the free cash flow, which is 108 million. So they have strong liquidity, so 425 million that they can have access to, and obviously 337 million in cash. And so this is not a company, I don't think, that's going to be acquiring anything, because they don't need to. I think they have one of the largest kind of reserves, 1P and 2P in the province for their size, I guess. So I just don't see them allocating this 337 to grow, but maybe they'll utilize it to kind of debottleneck some of their facilities to produce more oil, especially on Leismer. And we're going to be talking about this in more detail. So they successfully closed and divested that light oil division they had. Well, not division, but the 3,000 barrels they had there. And they got 160 million in cash. So what's really interesting about this for me is that they're able to drill pads, for example, in Leismer for, I would say, that price, about $160 million, and produce something like 10,000 barrels a day, 11,000 barrels per day. But they sold the 3,000 in light oil for that price, which is kind of remarkable to me. So, and I think it's like really smart business and very much not understood that you can spend, let's say, 8,000 per flowing on the thermal side, getting 10,000 barrels per day with the same money, basically taking that capital, allocating it, and tripling production on that cash, which is, in my mind, a smart business model. And I wonder if that's what they're going to do with that money, kind of developing more of their assets. Obviously, there's an issue in play, which is related to kind of the ability to generate the steam for a certain kind of level. So, for example, if your SOR is 3 and in Leismer you produce 24,000 barrels per day, then maybe you have overall capacity of generating steam at 75,000 barrels per day, and you cannot go beyond that. So, or they're gonna have to spend that money to maybe add another maybe steam gen or something like that to maybe increase production. And at that point, they become like a mini MEG, like half of MEG in a way. Now, MEG trades at $8 billion, right? $8 billion enterprise value, maybe a little bit more. And so if you're like 40,000 barrels per day in Leismer only, then your value for that asset could be, let's say, $4 billion, right? So 40,000, let's say you produce 40,000 and the MEG produces, let's say, 100,000. So you can be like a mini MEG, 40% of that, maybe like $4 billion, maybe $3.5 billion just for the asset. And the company trades like $2.3 billion enterprise value if you include the cash. And so I think there's a lot of kind of optionality here when it comes to the play. So from the thermal division, right, they produced 31,700 barrels a day. Out of that, 24,000 it's from Leismer, and about 7,459 is from Hangingstone. I think Hangingstone has kind of been put a little bit kind of on a back burner when it comes to capital spending, and maybe they're going to put some infills in there. But that Leismer production, the 24,000, that's quite remarkable because they brought this pad called L8. And I think about over 30% of the production for Leismer right now is from that one pad, that one sustaining pad that they produce. Because, and I reviewed some of the slides, I want to share that with you as well and see if people have any feedback. But that one pad, like, it has very high permeability. I think the permeability, so high porosity, about 35%. Porosity is basically the void where the liquid could be stored. And the permeability is the ability of fluid to move through the porous media. Now, the permeability in horizontal direction for that pad is 6 Darcy, and the vertical permeability is 5 Darcy. So it's funny that I'm talking about mag because Christina Lake has very similar kind of qualities to their oil and the formation. So I almost wonder if there is like an interesting angle there where it could be valued appropriately. So for the oil division, you can see operating netback 53.59, for Leismer 55, for Hangingstone a little bit less, $48. And the light oil division, 55% is liquids. They produced about 4,485 barrels a day, BOEs per day, right? So when a slide is BOEs, barrel of oil equivalent, it's not like actual density of the oil, closer to the one of water. So they have to kind of correct for that BOE. Yeah, and so the netback there is a little bit smaller, so $31 per BOE. So that's okay. And I almost wonder, like, if that's the plan going forward, is to keep those barrels or maybe divest them, right? Because they just divested the 3,000 barrels that they had. And what's kind of the plan for, for the other light oil parts? So we can see here in the table, and again, for those of you watching Razor Oil on YouTube as well, I'm doing a live with the slide deck. So maybe it's easier for people to see kind of versus listening to the space. So they basically produced about 36,000 barrels a day. Yeah, and on the expenditure side, it looks like on the thermal division, they spent about $31 million. So that's pretty good, right? Like you have like a small capital that you spend annually, right? And that's kind of in line with what they guided, and yeah, and they had very minimal kind of spend on light oil division. Cash flow, so free cash flow, $180 million for the quarter, and about 581 million shares, 582. I think it's about 570, 72, 73. So we're gonna see like how many shares they're gonna issue when they basically do the RSUs and the PSUs and all that. But nevertheless, kind of as they're buying back shares, they should be able to fight kind of against kind of the flow of issuing shares, which all companies issuing shares when it comes to kind of compensation for employees. Like, so I work for an oil company. Obviously, I don't work for Athabasca, but my oil company also issues shares for me to incentivize me to stay. It's not that much, right? But all employees and especially management, they will get shares in the company. And so now it's like if you utilize all of your free cash flow to buy back shares, and I think that's a big portion of their plan, and then you basically kind of reduce the share count, and those shares becomes a little bit more scarcer, right? So right now, if I was to look at their outlook at what they're saying here is, so the guidance in October 31st, 2023 is a little bit less than previous quarter. Why? Because they divested this 3,000 barrels per day in light. So they're going to be producing 35,500, 95% liquid. Adjusted funds flow, they expect 310 to 335 million, and the free cash flow 165 to 190. So that's kind of the annual guidance. And again, with those type of numbers, it's mostly if you take the annual for 2023, this could be a little bit less than 10% free cash flow yield based on what's shared today. But then again, they had like Q1 was a quarter where they had some really kind of strange, kind of some financial issue there where they had to pay a bank like 31 time payment and kind of close the books. I was kind of surprised by that announcement, but seems like the guiding kind of this 165 to 190 million in free cash flow, which if you take the enterprise value, you can see the yield. And capital expenditure unchanged, so 145 million. Now, if it sounds like I'm using like a bunch of numbers and it's so random, just think about kind of in terms of what the company is worth, right? So the company is worth right now about $2.3 billion. So think about your business or something that, how you would spend your money. So something is, let's say your house is worth $2.3 billion. I know it's unlikely, but could be the case. And you're spending about $145 million annually, right, on capital, right? you could advance this capital to improve your house. You can sell it for more, or sustain basically your house. But at the same time, the yield, they have like a free cash flow yield where they generate additional funds where they can do stuff with. And that number for this quarter was $108 million. So the way, if somebody is wondering like, well, how do they allocate that cash? That cash is being allocated between the heavy oil, so the oil sands in situ recovery, and the light oil division. And the partitioning is about 120 million goes to heavy, which most likely going to Leismer, and 25 million goes to light oil, which is very small now. I think it's about 2,000 to 3,000 barrels per day in recovery. Okay, so what else could be interesting here? So for the 3 months ended in September 30th, 36,000 barrels per day. You can see kind of in the slides. And again, if for those that confused what I'm showing, I'm on Twitter Spaces, not recording, but I'm recording on YouTube Live under ticker Razor Oil, and that's where I show all the slides. I find like I'm not streaming on Twitter because on Twitter it's like very small and people can't read the slides. Where I find on YouTube, when I'm very slow, people can kind of press the play speed or whatever, like, and make me like 2 times faster. And I find some people benefit from that as well. And the main incentive for doing this is really kind of revisiting the numbers, sharing with the community, seeing maybe people, have comments, just make sure I don't have any blind spots about what's being shared and what I think is kind of happening here. So realized prices for Q3 were really nice, actually. So for oil and condensate, for heavy oil, it was about $90 per barrel. For oil and condensate, it was 104. Natural gas was 286, so it was a little bit smaller, right? If you compare it like this time last year for realized natural gas prices, it was about 429. But again, this company is not in that business. It has only like 5% lighter stuff. So maybe kind of a little bit de-risk, even though it's very difficult to compare 2022 to current prices, because we had this huge spike in oil prices as they kind of declined. And the operating netback for a net of realized hedging is about 49.70. So that's pretty good, I find. Okay, let's see what else is here of value. So they basically describe kind of their thermal business, but I'm probably gonna do this in the slides. But let's see some of the stuff they say here. So they have 100% working interest. For Leismer, they have 40 years of reserves, life index, and approximately 85 years proved plus probable. So sometimes like people go on BNN Bloomberg and I would say 90 years or 100 years. I think it's important kind of to keep it more reasonable to the actual numbers. So here they say 40 years, right? So that could be like a 1P, very probable, very, and soon I will show you slides where I think that's kind of what they're alluding to. So around that L8 kind of region, and 85 2P. So about 698 million barrels of proved reserves. So that's kind of, I think that's where I think they're going, right? I think like if the more I look at this, and obviously they have this corner lease, and my hope is that, I don't know, they're not going to develop it anytime soon, because I really kind of feel like they should focus on Leismer, but they do have this like huge package of 353 million barrels of probable reserves, proven and probable reserves in corner, but that's going to have to be like a greenfield development project, right? So, and they have regulatory approval for 80,000 barrels per day for those 2 assets. So I think for Leismer is 40,000, for corner is 40,000. And so we've been seeing some companies going and doing kind of greenfield development, like BlackRod for IPCO, International Petroleum Corp, spending about $1 billion developing 30,000 barrels per day and producing those in 2028. So I don't know. I don't think I'm personally a huge fan of that, but this is like more of a long-term investment for the asset, and that could be what corner may look like. So some of the free cash flow and some of the cash, if management decided, could go to that. But I hope they just kind of stay in Leismer and develop this asset, because there's just so much opportunity there, especially as I'm looking through this geology. And obviously they have this 100% working interest in the Hangingstone asset, and I will show soon the production there. It has about 25 years of life index and 60 years of proof probable. So everything like related to Athabasca here is like everything is in decades, right? So they don't have to go and like buy anything or do anything wild here. Okay, so I think we kind of covered in details what's going on. I'm now going to go and share. Oh, cool! We have like 25 people watching me live for the slides, so that's pretty awesome. Thanks, guys, for joining. So now I will show their presentation and maybe kind of share some of the thoughts from the presentation itself. And I think like there's one aspect that kind of makes me a little bit more excited, and I want to hear some thoughts from you guys if you think this is the way for them to go. And obviously we're going to be speculating, because the key here, and we almost have to speculate, because there's this $337 million in cash and about $212 million in debt. And they could probably go and right now pay off this debt, or they can take that money, keep the debt, pay it for every year to whatever that deadline is, and kick the can down the road in a sense, but then deploy capital to generate, more returns in the future. And so this could be a potential path here. So just like ARC develops Atachi and looking forward into like 500,000 barrels per day by, I don't know, 2025, kind of towards 2026, but return on capital will be significant. Maybe this could be a path for them as well when it comes to growing their steam capabilities, debottlenecking the back facilities, and then becoming like a mini mag with maybe 40,000 barrels per day of Leismer production. And then, like we talked, if Mag trades at 8.8 billion or at 8.5 billion dollars enterprise value, and you had 40% of that, then you should be trading at, like, including Hangingstone, including some of your light oil assets, you should be trading at, let's say, closer to $4 billion in enterprise value. Well, and that's double from here, right? So maybe that's kind of the plan for the company to allocate that capital. So now on the map, and again, for those on Twitter Spaces, I'm showing a map now of Hangingstone Corner, Leismer, exactly where they're located. And so you can see like that circle here. So yeah, most of the production is like thermal, right? So it's very easy to see how this could be a mini mag. I wonder what they're going to do with that light oil division. The $25 million they allocate on quarterly basis, maybe the plan is to monetize, maybe what they've done with kind of those recent asset divestiture, maybe this is the plan. You make this asset to be essentially 3,000 barrels per day. You just said 3,000 barrels per day sold for $160 million. Maybe you create another one like mini asset like that. You get back another like $140 million. You add to the 337 million you already have, and now you have about $500 million in cash. And now you could easily like debottleneck something, or while you basically returning free cash flow to investors as expected, so you don't disappoint, but at the same time you kind of deploy that capital towards more production in the future. So as we can see here, so this got updated from the Q3 earnings. I see that they have 577 million shares now, which is nice to see, because they had a situation with warrants and then they had to issue shares. My understanding there's like another, could be another, like, I don't want to say the number because I don't remember it, but I think it could be close to 90 million shares. 90 million shares translated to, I think there was like a multiple of like 277 or something, like maybe like 20,000 warrants. I'm not sure exactly what was that translation, but there is another like a little bit less than $100 million in warrants. But my understanding is that when they issue warrants and give you shares, it's a positive for the company. And overall, basically, it's like you remove that kind of monkey from the back, if you will, and you're kind of done with that. And because all corporations have some kind of like warrant situation. So here we have basically 337 million in cash. Could that be used to pay off the warrants? Maybe, I don't know. So the guiding for 2023, the guiding 34,500, capital expenditure 145, as you can see here. Share buybacks estimate 150 million, and so that 150 million could be, if the share price right now is $4, so that could be like 40 million shares or something like that. So maybe a little bit less. Yeah, and so share buyback as of year to date is $113 million. So yes, at about, I don't know, what would that be if we divide by 4? So let's do that. How many shares they bought? And sorry, my apologies. This is like in-depth kind of analysis of Athabasca Q3 earnings. Yeah, so 28 million shares out of 570, 580, 577. So for those of you listening on Twitter Live, I'm also streaming on YouTube Live under Razor Oil, and I'm showing all the slides. So maybe it kind of will be easier to get a little bit more clarity. We have about 27 viewers. Okay, so again, just kind of to reiterate what their top tier long life asset means: 1.3 billion BOEs and 2P reserves. And I think we saw some of their disclosure. Net cash position 155. I think I agree with that. So 337 minus 212. Maybe they reduced it a little bit more. So could be 155, could be 140, 135. Depends how fast they paid off debt and bought more shares this quarter. Yeah, so we see here that record cash flow 141 and the spend 35. So we're 108 free cash flow yield, and they have 155 million in cash. Okay, so this is getting interesting. So that's their forecast for the WCS heavy differential. What's kind of like, I don't want to give them too much credit, but they've been pretty good in assessing kind of those differentials and how they move. I noticed like even last year when they forecasted for late kind of early 2023 where differential is going to be a little bit higher. We did see those numbers. We still have differentials that a little bit higher. I think about just over $20, maybe a little bit more. But they think that because the TMX is coming online, that differential could be somewhere between $10 to $15. So that's pretty good. And then they're looking at kind of Canadian egress outlook, and they plot for us here that opportunity that 590,000 barrels per day through TMX creates essentially an envelope where the differential should decline. So let's see what they say here. So Canadian heavy oil differentials, transient headwinds in the rearview mirror, U.S. heavy weighted strategic petroleum reserve releases. So SPR is not being released. So I reviewed the data for the past, I would say, 8 weeks, and there was no SPR released. I think there was like 1 week where they actually filled the SPR by like 1 million barrels per day out of like 571 million, which is like nothing. And here they also say TC Energy Keystone pipeline leak, which caused the differential issues. Tailwinds expected. So tailwinds, I guess, is a positive, right? Improving demand as China emerges from COVID restrictions. And again, this is like one of those topics that is interesting, because when the thesis is that China did not come back fully, if you're looking from the other kind of side of the coin, well, China will come back fully if one speculates if it will in some point, right? So maybe this is a tailwind here based on what they're saying. New global heavy oil refining capacity, so 350,000 barrels per day in Mexico. Trans Mountain expansion, so they're talking about the TMX 590,000 barrels per day, expected in Q1 2024 or H1. I guess H1, the Q1, Q2, I guess. So let's see, right? But again, the markets are supposed to be forward-looking. So the prices that we're supposed to be seeing in the next couple of quarters supposed to account for it right now. And lower industry supply growth with focus on return of capital. And this is something, I've been kind of advocating for historically, not in the sense like advocating for it to happen, but saying, look, we have to be mindful of the fact that that the companies do return capital in the form of buybacks or debt reduction, to shareholders. And maybe Athabasca here kind of acknowledges the fact that there's the supply growth will be smaller because the industry in overall is committed to returning free cash flow to investors, right? And so this is maybe kind of a little bit more of an admission to saying, like, we are aware of the fact that investors demand of us or expect from us to deliver on returning capital or returning basically free cash to investors. So why are they saying they're uniquely positioned here? And again, in my mind, they're uniquely positioned because they have like the significant amount of cash. First of all, $337 million, huge operating netbacks, right? Over $50 per barrel, about 212 million in debt, and 155 net cash. And yet, there's this kind of opportunity to not only divest some assets, the assets they already divested at 160 million, but also debottleneck some facilities and kind of be a little mini mag, And so that pad L8, by the way, with the 6 Darcy horizontal permeability and 4.9 Darcy vertical permeability at 35% porosity and 83% oil saturation. This is Christina Lake type of numbers. And I see my friend Rock Freak there. He could probably kind of speak a little bit more to that as I open maybe the space for further discussion. But if those rates are what I think they are, those are 1,000 barrels per day wells right now that's sustaining Leismer. And you have like 10 well pairs. So this could be an 11, north of 10,000 barrels per day from one pad in Leismer. So interesting kind of development here when it comes to the company, right? Cash flow torque. So WCS differentials. If you have essentially like $5 US change in the differentials, they're able to have additional $80 million in cash flow. And differentiated long life reserves, obviously they don't have to buy anything, right? There's like 1.2 billion barrels of 2P heavy oil reserves. This is like, we're not going to be alive by the time they're done with it. None of the people in the space will be alive, let me assure you that. Because if they're talking about 90 years of 1P, 2P, 40 years of 1P, 90 years of 2P, and you older than 10 years old in the space right now, and you're going to live till 100, well, that's probably when they're going to be done with just recovering that 1P and 2P, so that's interesting. For the adjusted funds flow here, they show us a chart of sensitivities, and I've seen this chart before, they didn't change it really, but they're showing here how between 2023 to 2025, they could generate $1 billion in adjusted funds flow, right? No, in free cash flow, but for the adjusted funds flow, they give you basically the range of the movement. And again, for those in Twitter Spaces, I'm on YouTube Live under Razor Oil showing the actual slides. So they kind of show you that sensitivity, right? So if you see that blue line, right, and let me do those calculations right now as we speak. So if they do the blue line is $70 per barrel US, right? And I think the assumption they have here is there's about $13, $12.5 in differential. So that will be like where we are right now, I guess, like 57, 58 WCS. So they're able to generate over the course of time in 2024 about 400 billion in it seems like in free cash flow, if I'm reading this correctly, and in adjusted funds flow, and about 800 million in adjusted funds flow if oil price is 100. So they kind of give you that range. We don't know where we're going to end up. We don't know like what TMX differential is going to do, or whether it's going to come online, right, or when it's going to come online. But we do know that kind of range of sensitivity. And so they could also decide not to, for the adjusted funds flow, to get the free cash flow yield, they may not use the capital or not grow strategically if prices decline, and obviously they're not going to generate that 1 billion return in free cash flow. But at the same time, that range kind of gives you a little bit of an optimism here, where you could have a return of, let's say, maybe $1.25 a share, something like that, for the stock, right? So that what they're basically suggesting here. But at the same time, we have to be realistic, like what this number could be. So if we stay in, like, oil prices basically were $90, so, and now they're maybe 77, and could be a little lower, could be a little bit higher, but you kind of get the idea of the range. Now, when it comes to production, so for 2025, they think they're gonna be producing like closer to what I see here, like maybe 40,000 barrels per day. In 2024, it's going to increase a little bit, maybe 37 or so. In 2023, if I'm looking at the graph, is about 35, 36. So that's basically what we've seen kind of last year. So really sustaining kind of production here, which is great. Okay, so the capital allocation program. So when you take that adjusted funds flow, you can see in this chart there is a small portion that goes into sustaining capex, and you have that excess cash flow. They use a little bit on growth capital, and that's how they kind of have that 75% ECF. And then they have additional cash flow, maybe that could be used to drill some infills, I'm not sure. And share count reduction, so Q1 2023, they suggest they had 649. What is this? 7% reduction in fully diluted share count here to date. So maybe it's kind of adjusted to those warrants that were kind of converted to shares. So now I think we're like at 577. Okay, so if you look at the thermal assets, you can kind of see numerically what they're producing here. So on the thermal side, 31,700, and on the gross reserves, you can see that 1.2 billion that they talked about, 40 years of 1P, and about 100 years of 2P, over 100 years between Hangingstone and Leismer. So that's pretty cool. Okay, this is an important chart here. If you guys, for those of you that are listening for Twitter Spaces, you need to go probably on YouTube Live to see it. We have about 25 people watching this. Okay, so these guys for Leismer, they are in pre-royalty status for payment. This becomes important. There's a sliding kind of scale for the payment. So if we'll, let's say, use this blue line here and we compare it to post-payout red line, you can see 1.9% royalty on gross revenues less transportation, right? So right now, the estimated royalties, for example, for Leismer and Athabasca and Hangingstone, because they're at this pre-royalty status, they're paying, it seems like, between, I would say, maybe 3 to 5% at $80 WTI, a little bit less, so 77. A company equivalent to that type of production transportation, if they're at post-payout status, will be paying between 25 to 30% in royalties. This is just the royalty kind of oil sands royalty rate framework that exists in Alberta. So Leismer will get to post royalty status in 2027, I think. Yeah, so based on the slide, Leismer to remain pre-payout until 2027. And I think that estimation is based on current production rate, because as you generate that revenue and you're getting closer to that post-payout status, you will be kind of, that's the time frame they estimate, 2027. And Hangingstone to remain pre-payout to 2030. Now, why is this slide important in my mind? Because if they were to say, okay, we're going to grow this asset like exponentially and double production tomorrow, and now you can start kind of looking at the revenues for this quarter and looking at the production oil rates, you can basically say, look, you can say, well, they're expediting, they're accelerating the pre-payout status. So maybe the growth plan is sometime, if you were to do this calculation and kind of did this offline, it looks like they're going to be able to, oh, okay, I have some comments here. It looks like they going to be able to basically get to this post payout for those provided timeframes. Okay, so it seems like okay, so Courtney says let's fucking go, which is great in the comments here. So I can read comments from YouTube. Looking good, can see them perfectly. So thank you for that, David. And earlier this year, I read that ATH has 2 steam generations in inventory, bought and paid for comments. Yeah, so it could be, right? GA Rowe made this comment about that there is like steam gens in inventory. And I'm not sure what engineering would cost for that, right? To put it in. But we do know we have about $337 million in cash and 212 in debt. And in about 2.4 billion enterprise value. And so if you kind of use that capital to deploy and grow your production and keep the debt, maybe it's good use of capital. Maybe, I don't know. But if you have those steam gens and they're paid for, what would the engineering would cost to put them? I mean, I hope it's not too much, but the asset is going to be debottlenecked and being able to produce 28,000 barrels per day, right? So 28,000 barrels per day. And then if you're thinking about growing to 40,000 barrels per day, maybe those steam gens will be used for that. Because my understanding, they use like non-condensable gas co-injection right now, NCG co-injection, to maintain the bottom hole pressure in the older pads while the steam L8 and produce significant amount of oil, over 1,000 barrels per day. So this kind of remains to be seen, but nothing here is like crazy, outrageously crazy. The one thing that I noticed, and I don't know how you guys think about this, is there's significant amount of optionality here. And some of the comments they make also is that royalty structure depends on whether the project is in pre-payout and post-payout status, and advantage designed to support the recovery of initial investment. I think that's exactly right. Now, for those of you, if you love, let's say, Cenovus, Christina Lake, well, in this chart, I love Cenovus, Christina Lake, by the way, great asset. Cenovus, Christina Lake is paying right now about 26, is this in dollars? $26 in royalties. Same with Foster, CNQ Jackfish as well, 24.80. Strathcona Tucker, 21.30. Those are post payout status. And on average, they pay $21-30 per. And this is kind of, I think, in my mind, this was part of my thesis when I was comparing, let's say, a MEG to Athabasca, is that, yeah, sure, a MEG, maybe you have cleaner sand, but now they're in post payout status, and you have this kind of almost like a financial engineering angle where it's not just the geology, it's also kind of like your royalty status that makes an impact on return on that you get paid in the netbacks, right? We can see here Strathcona Orion is 1860, and Strathcona Lindbergh is $9.60. And then you have some other assets. So Hangingstone, Athabasca is $6 per barrel in royalties. And we have, what else we have here? So Leismer, $6.20, right? So that's pretty good. That's pretty good. Okay, so this is, for me, guys, this is the chart for me, right? I'm not trying to over exaggerate what I'm seeing here, but if I was to guess what this company is going to do, this will be the chart. Again, for those of you watching me on YouTube Live, thanks for that. So, but if you want to see the slides, you need to go on YouTube Live, Razor Oil. Okay, so the drilling that pad L8, right? The drilling that pad L8. Let's see if I can pull the geology specs for L8. Okay, so I'm pulling it right now, the geology. Okay, so maybe I'll stop sharing here. Stop sharing. And I'll share this next. So I'll present slides, no, share screen. And what's the name of this? 1 second. I think it's important because if this is what I think it is, then it's, yeah. AOC. Sorry, guys, bear with me. Okay, here, I'm sharing this. Okay. So, Rock, I hope you're on YouTube because you could probably confirm what we're looking at. So if you look at these numbers here, pad L8 right here, so it shows 5 well pairs, but it's not. It's about 10 now. I think it's maybe 10 or 11. So they went bigger here. They went to 1.25 kilometers in length, okay? And oil saturation 82%, porosity 35%, horizontal permeability 6.2 Darcy. So that's a Christina Lake-like permeability. And vertical permeability 4.9. I don't see any pad here from the past that had similar, and net pay 25.8 meters, 25.8 meters. So for me, this is like game-changing pad, right? So why am I showing this? Because if we look at their presentation back, so okay, I'm gonna share this right now. So that region right there, pad 8 south, they said they have 5 well pairs in 2022, but now they have 10. I think they hit kind of the jack spot right there, right? Because if this is 6 Darcy there, horizontal, and 5 vertical, this could be game changing for that asset. And you can see that the plan here is planned pad in red. Maybe they'll go and just land that another well, like 4 well pairs there, and maybe like in perpendicular to L8, another one, just kind of to recover that oil with high permeability and high porosity and high oil saturation. So what they say here, let's see kind of what they say. Pad L8 expansion, new 5 wells on stream in Q3. Yeah, that's what they've done. Expansion project, 14,000 barrels per day, barrels per day. So, okay, so essentially what they're saying, they're going to be paying $14,000 per barrel per flowing on capital efficiency, right? So if you have, to put this in numbers in context, if you have, let's say, a MEG, right, and it produces 100,000 barrels per day, and the enterprise value for MEG right now, let me take a look. Yeah, so MEG is $7.5 billion in market cap and about billion in 1.2 billion in debt. So that's about 8.7 or so $billion enterprise value, producing 100,000 barrels per day. They trade at about, I would say, 84,000 per flowing, 85,000 per flowing. So you could, the expansion project cost will be 14,000 per flowing, 14, right? So that kind of makes sense to me. December 1st, steam on 4 infills pad L7, 4 well pairs on pad L8. So in December, interesting. So they're gonna put another. Wow, this is cool. So they're taking that pad and they're gonna steaming another 4 wells for L8 and gonna put 4 more infills in L7. So infill wells are wells that kind of you land between the neighboring injectors and producers in a way, in kind of that teardrop shape between the chambers. But that oil is kind of mobilized, so they can just land the producing infills in there and produce that oil. So hopefully they have success. I know they had success in the past from the other pads, but yeah, I think they could achieve that 28,000 barrels per day on Leismer, right? Without the steam gens that's sitting there. So what would that mean? So let's say if you think about Leismer at 28,000 barrels per day, what does that look like on the value of the asset? So how can we value that asset? Because if the geology there is Christina Lake-like, but it's not uniformly like everywhere, and MEG trades at 80,000 per flowing, so how much should we discount it that by? Okay, so let's say 60,000 per flying. Let's take a big discount. So 60,000 per flying, that makes Leismer only at $1.7 billion asset value. But if the oil production is the same, over 1,000 barrels per day per well, maybe it's too kind of conservative an estimation. Maybe it should be closer to 70,000 per flowing. I don't know if somebody was to pay for that. So 28,000 barrels per day times 70,000 per flowing, that will be about $2 billion, which is they're not far away from that now from their enterprise value perspective. So it's kind of an interesting angle here. It's quite intriguing. Like if they're able to grow to 40,000 barrels per day on the asset, then it kind of for sure becomes like a mini mag in a way. Okay, let's see if we have any comments from people. Okay. Can a SAGD operator introduce solvent technology to existing production, or is that tech for a new project? Oh, I cannot talk about that for sure. Yeah, there's a big conflict of interest here. I cannot discuss that. They could do whatever they want to do, but yeah, I'm not sure. I'm not sure. I don't think that's the plan based on the slide deck. Okay, so future options, regulatory approval. So essentially for 2024, they're sustaining, and then into 2025, they have this expansion plan to get to 28,000 barrels per day at the cost of 40,000 per flowing, 14,000 per flowing, 28. So, okay, so that's cool. Okay, let's do this calculation. So this is some, see, that's why I think it's useful, because it kind of forces me to sit here and do this and just see people's feedback. So they're producing right now about 24, closer to 25,000 barrels per day. And they will grow to 28,000, let's say. So that's 4,000 barrels per day to be conservative, okay? And they're saying that the expansion project cost is 14,000 per flowing. So they're basically telling us the cost, okay? So let's see what that is. 14,000 times 4,000, that's 56 million, guys. They have 337 million in cash. And they're talking about spending 56 million to get to 28,000 barrels per day. And the question is this achievable? It's very achievable. Now, they had free cash flow for Q3, $108 million. So for next quarter, if you keep that cash, you keep the debt, your net cash 150 million, and let's say you spend half of your free cash flow that you had in Q3 on that's a good investment. That makes sense. Now think about this. This is something that comes to mind. They just divested 3,000 barrels per day in the Montney, receiving $106 million. And here they can increase 4,000 barrels per day in thermal for 56 million. So for a third of that cost, right? For 56 out of 160, they could increase by 4,000 barrels per day, basically infinitely in a way for the next 100 years, right? Because they're going to have the steam capability or whatever, and the ability to debottleneck the oil, process it. So they create kind of an environment of sustaining longer, like higher production for longer, basically using only 14,000 per flowing, which is $56 million. I don't know. You guys want to call BS on that statement, or I didn't see any other comments, but please let me know. But as I'm thinking about this, I can totally see Leismer at 28,000. But then if the net asset for Leismer then is $2 billion, right? And the current enterprise value is 2.3, and now you have 150 million in cash, and you have Hangingstone as well, and you have the other 2,000 to 3,000 barrels per day in conventional. Should you be trading at $2.3 billion enterprise value? So this is kind of a thought-provoking kind of question. Maybe not. I don't think so. Okay, and then they're looking 2026 to 2027 at 40,000 barrels per day expansion potential. We don't really know if this is something they're going to pursue. And the main question for me, guys, is like, okay, well, if they're going to be that company in 2027 producing 40,000 barrels per day, first of all, there is not one company that does that right now. So there's no company that is in this range of oil production in thermal, right? All the companies we know, they they have like, for example, the Strathconas of the world, they have small kind of miniature assets, maybe not like Lindbergh or Tucker, but like 20,000 here, 25,000 there. But they're kind of one entity right now. They're not like a Meg or an Athabasca where they have like a certain range for thermal production. Meg is kind of in its own league in a way because they're publicly traded, and nobody else that's publicly traded has like 105,000 barrels per day production per day doing thermal. But if Athabasca becomes that company right now at 40,000 barrels per day thermal, why wouldn't they just have this one asset? Why wouldn't they be, and if you have, let's say, 40,000 barrels per day sustained in thermal, you become, let's say, a mini mag, and you trade, let's say, at 70,000 per flooring. So 70,000 per flooring times 40,000. Well, that's $2.8 billion, and we didn't even account for everything else. So it's kind of, and then to expand to 28,000 barrels per day, you only spend $56 million. So I'm having a really hard time really understanding if this company, like people say, oh, okay, maybe it's like highly levered and all that. But this is like, for me, there's a lot of like really cool optionalities that create an environment of pure value, right? Because if, let's say, oil prices decline, so they basically go to their COVID mode where they don't spend anything. They also can cut production just like they did in Hangingstone, just basically not producing anything and not spend anything and just kind of sustain. And, they have as much cash as, they would have generated maybe in a current environment, let's say, I don't know, mid 50s WCS for like a year, and they could be fine. So I don't know. I just don't feel like there's too much pressure here on management team to do anything wild. And I really, really like on the development plan, like if I was to zoom in here, I love those planned paths for development. I love it. Like if L8 is what they said it is, this is mini Christina Lake. And I wonder, like, to the northwest side of L8 pad, if that geology is like L8. I wonder, I wonder if that's what it looks like. Now, they're kind of smart about the central region, because they put this like rectangle there of planned pad, but it's almost like under the or adjacent to the previously steam chambers. So maybe they're kind of trying to harvest some of that energy for the mobile oil that they had and kind of maybe accelerate production that way. But I almost like want them to just develop like really close to L8, just kind of just stay close there. The great geology, I think they could do a good job. And this is the economics for L8, so mid L8. So they basically spend 6,000. Yeah, what is this now? 6,000 per flooring? No, plateau rate per project 6,000 barrels per day. Okay, so well per type curve. Oh, they're actually telling us so 1,200 barrels per day per well per payout. So I think that's what it could be right now, that some of those well pairs are producing this right now. But they say here that the payout is 10 times in 5 years. So they basically spend the capital, but I think it's, you have to account for the oil price, right? Like it's not going to happen in every oil price. And maybe here in small letters, the assumption here is that this economics are based on $84 WTI and $12.50 differential, essentially suggesting WCS kind of lower 70s, maybe lower 70s, with capital efficiencies of $8,000 per flowing, which is great, right? So remember, to expand to the 28,000 barrels per day, additional 4,000, which requires, I guess, some kind of engineering, like surface facilities engineering, you need to spend 14,000 barrels per flowing. Here, those type of pads are costing only 8,000 per flowing. So if they produce, let's say, if they produce right now, man, I'm looking at the 24,000. I think they're producing about 10,000 from LA. They have to. So if we have 10,000 barrels per day right now, and they spend maybe like 8,000 per flooring. 8,000 per flooring. That's $80 million for the entire thing. And here they say basically the capital is 48 for maybe like half of it. So it makes sense to me. I don't know. It just looks like really healthy economics. So let's see some of their highlights of what they're saying here. Project underpins corporate cash flow and torque to oil, low crown royalties, so 9% max pre-payout, 40% post-payout, $1.4 billion royalty balance to pre-payout in 2027. Okay, so that's cool. So think about this. So basically they generate those revenues, right? And they tell us that at $85 WTI, they're going to reach the post payout in 2027, but they also gave us the number 1.4 billion royalty balance. So you can take the royalty number. I think what was the kind of the revenue number here? The revenue number. Sorry, bear with me. Kind of add the revenues, I guess. I'm just looking what was the actual revenue before. Oh, it's not easily extractable here. But anyway, you could kind of divide by the quarters, 1.4 billion by each quarter. So to 2027, how many quarters we have? We have maybe 25 to 24, 25, 26, 27. So 4 years, 4 quarters, 16 quarters and 1.4 billion. And you can kind of see the estimated revenue for $85 WTI. So that's exciting. The power of compounding. Leismer underpins slow corporate decline. New wells have flat production profile of 5 to 7 years. And I think this is something I've been talking a lot about, that those decline rates are like minimal. And then even when it declines, you can put like those infill wells that they plan for the central region there, kind of sustain production because that oil is already mobile. The steam, the heat transfer already happened. So I just kind of feel like even if they're not able to have like 10 times payout in 5 years, like would 5 times be more conservative? But it's still a really good return on your investment, right? If you were to invest in something and over the next 10 years, that one thing pays like 5, 6, 7 times for itself, where you can take that cash, survive maybe in an environment of lower prices and maybe kind of, torque your business a little bit. It just feels very healthy, even though at 85 WTI here, they kind of guesstimate 10 times payout in 5 years. $5 per barrel margin improvement with added scale to 28,000 barrels per day from 22, but they're already at 24. So again, for those of you that are listening to me on Twitter Spaces, I'm also streaming on YouTube Live. I think I almost have to do it because, first of all, I'm kind of getting a little lazy, like when it comes to actually sitting on my ass and looking at those numbers. Secondly, if I'm able to explain them and people call BS maybe on some of those numbers, then maybe it's kind of, there is a little bit more of a due diligence aspect to it. So if you see something that maybe I'm wrong about, or I don't understand something, let me know. So this slide, again on YouTube, you can see the slides. This is Hangingstone, right? This was one of the reasons why I actually I was really convinced that this is the way to go for me, because somebody told me, we're just having beers, and somebody said, oh, they're not making any money, and I knew about that NCG implementation strategy that you can see here on the slide. So NCG, what it stands for, and look at kind of COVID production. Look at COVID production, guys, right? So they produce about 8,000 barrels per day. In COVID Q2, Q3, 2020, they shut in the whole thing, right? Like, remember the times when during COVID, you maybe hold oil companies and you say, man, oil prices are negative, just don't produce. Just don't produce oil, don't sell it. Why would you sell? They literally shut in the whole thing. Take a look, right? For 2-3 quarters. And then they ramped it up back to 7,500. And then they were able to kind of get to closer to that 8,000 barrels per day, basically oil production rate. But look at the SOR. So SOR up until COVID was closer to 5. Now SOR stands for steam to oil ratio. So when they talk about Leismer, and if I go back here, the development chart for Leismer development, They're talking about 28,000 barrels per day, but that's mainly through the bottleneck in the back end. So that's kind of processing the oil, removing kind of the water, able to flow that oil basically to the back. The 40,000 barrels per day, it's an expansion that I assume requires more steam to produce more oil. Now, what you see here is kind of a different, kind of almost like mentally gymnastics kind of exercise. They don't say we need more steam. They say we're just going to co-inject NCG, which is non-condensable gas, which is essentially methane, and maintain the pressure, and that allows us to remove that steam that from injecting and utilizing that steam on other wells. And so surely what you see next is that they come out of COVID, and then they grow production from 7,500 barrels per day to about 9,000 barrels per day and sustain it until essentially 2023 without developing any new pads. And now we're only starting to see like declines on those pads as they continue to decline. But the SOR now went from 5 to 3.5, which is huge, right? So the question now, like what happens to those steam kind of capabilities? What can you do with those? And I think, and this is kind of what I saw with the regulator now, and I'll share some of the slides. I think they want to drill well pairs, not infills, just well pairs adjacent to the pads that they developed, and kind of grow that recovery scheme and use surface facilities that's still kind of on site, but do a little bit more with less in a way they kind of repurpose stuff, and they utilize that steam, maintain pressure with non-condensable gas, which is kind of on the vapor pressure curve. NCG co-injection is not kind of soluble, but it's also not condensable. So it's just there, maintains pressure, which is what you want for chambers not to collapse. And I think it's just really, really smart business. And if I'm looking at the Q3 reported operating netbacks for the company, so they reported for the thermal division, when it comes to the netback, they reported $55 per barrel for Leismer and $48 for Hangingstone. So when I hear people saying this is a bad asset, is not making any money, well, if I'm making $48 per barrel, I am making money. Like there's no, like I literally get $48 for that barrel per day. Like, so there's very little confusion about that fact. So I'm not even sure why people kind of get emotional about saying, well, this is good, this is bad, and just kind of really oversimplifying that story, right? Now, on the cost optimization, it seems like there's third-party trucking terminal. So this is maybe where some of the cost is being lost, right? Maybe there's the pipe is not there directly to the asset. Maybe there's some trucking exercise, and that's how you lose some of that operating netback. And let's see what else they say. Maximize margins in near-term free cash flow, 120 million 2022 operating income at $38 per barrel. So I actually think, guys, I don't think this is like their core asset. I wonder, in my mind, I'm thinking, okay, well, this is like 7,000 barrels per day. I don't know if it's it's not super core, even though it's like one of the original assets. I wonder if somebody like a Strathcona or somebody could come in and maybe like just take it, or I don't know. I'm not sure, because if they, and again, this is like pure imagination. I'm not like, I know what they're telling us about their strategy. I know what they're telling us. They're basically telling us we want to grow Leismer from 24,000 to 28,000. We want to be at 40,000 barrels per day, maybe with expansion by 2027. There's this other corner asset. There's $337 million in cash. There's about 1,255 net cash. At the same time, I'm kind of reading between the lines and I'm thinking, okay, Leismer is the core asset, Hangingstone is okay. It's okay, it's there, but maybe it's something that they could live without if they take the cash. Maybe, just kind of me trying to assess kind of what's important here and what's not. And of course, guys, of course, this is like the light oil division, that Kaybob Duvernay. And again, I see my friend Rock in there. Guys, this is remarkable to me, because if you take $56 million and you can add 4,000 thermal heavy oil, but now you sold for 3,000. This happened this year, right? You sold 3,000 barrels per day for 160 million. I wonder if this destiny for those barrels, for the 2,000 BOEs per day in Kaybob Duvernay, which is like really highly kind of respected, lots of neighbors, as you can see here. We have a Chevron there, we have a Cenovus, we have a PetroChina, Whitecap is right there next to the Trans-Canada pipeline. We have Paramount, lots going on there. Really great economics on the wells. But I almost wonder, like, let's say you take a Hangingstone, right? Let's say, I don't know, what would Hangingstone cost right now? Let's discount it. Let's discount Hangingstone. Let's give it, let's say, 8,000 barrels per day, and give it maybe like, I don't know, 50,000 per flooring, because Met trades at 85,000 per flooring. Let's give this one. So that's 400 million, right? 400 million. And then I take another 150 million or so if they're able to grow this production for 3,000 barrels per day. For the Kaybob Duvernay, maybe 500 million. And I take the cash, which is like 337 million. Like, between all of those things, I can find at least $1 billion there of value in corner that's not developed, right? And then I'll layer another 28,000 barrels per day Leismer, which is about 2.3, 2.4 billion. And if it goes to 40,000 barrels per day, well, that's like a mini med we're talking about. So that's kind of my personal imaginary vision that may or may not be real. But I'm thinking, man, there's just so many like interesting ways here to approach this, where the optionality is, like, you can make a mistake and then you could be okay kind of not making that big of a mistake, so it kind of creates a unique environment. Gotta go watch rest later. Thanks for doing this, Razor. Okay. Yeah, thanks. This is like my first time commenting. Oh, okay. Yeah. So, when I go live, so when I'm live on YouTube, I can actually see people's comments. And then when I say show, it shows their comments. So see, you can see on YouTube now, it says, gotta go watch rest later. And here I'm saying, thanks. So it's like on TV almost. I love this one. Let's fucking go. Yeah, let's fucking go, guys. I think, and that's a challenge, right? Like, sitting like this, talking to myself, explaining. I really want people to call BS on what I'm saying here. I really want somebody to say, you're not thinking about this correctly. There's a different way to look at this, guys. Please, this is kind of the discussion. Okay, let's look a little bit further in Kaybob, not kebab. Kebab is something else. We're talking Kaybobs. Kebab, it's much cheaper. Kaybobs is a little bit more expensive. So let's look at the capital. Again, the spend minimal here, capital 9.6 million, 9.6 million, very little, right? I mean, what can you do for $10 million in conventional? Like, what, like, drill a well, like one well, maybe two, I don't know. But recycle ratio 4.5, liquids yield 78%. Wow, this is nice. Man, I wonder if they can monetize this. This will be nice. Even though I see some of my good friends here will say, well, maybe it's like vertical integration. Maybe it's a positive. It could be. I don't know. It could be. But at the same time, I can see the money behind the value of those assets. And I'm thinking this company is not worth $2.3 billion. It's just, there's more optionalities here, more layered things. And if you kind of forward looking, there is some value here that could be monetized, right? Okay, so this is the team: Rob Bruin, Matt Taylor, Carla, Mike, and Cam. Okay, let's see what else of value here. Oh, okay, tax pools. We talked a lot about tax pools and how do you monetize tax pools. So this illustrative tax pool valuation here and NPV 10 shows kind of the actual money in dollars or cents, right, per share. So out of the $2.8 billion, 2.3 is non-capital loss Canadian exploration expenses and 100% deductible. So again, how do you monetize that? Like, between, let's say, Hangingstone 400 million, cash 337, conventional another 100 million, and if I'm looking here per share, you get 50 cents here on 310 million, I guess, from that 50 cents, 75. I don't know, maybe give it like a 40 cents here and overall. I don't know. Maybe like maybe yeah, I think it's appropriate. Like the stock trades at $4, right? $4 right now, and you have 2.8 billion in tax pools. And let's say you can only use 10%, only 10%, 280 million, right? 280 million. So 10% of the EV, that's 40 cents, right? Um, so maybe there's kind of additional angle here that if somebody is looking, maybe they can kind of utilize that. But when it comes to there's 200 million out of those tax pools in capital cost allowance, class 41, and that red one is 160 million in Canadian oil and natural gas property expenses. But the biggest one, the 2.3 billion, is 100% deductible on non-capital loss and Canadian exploration expenses. And I assume it has to be associated with the assets themselves, right? Okay, so there is a little bit advisory here, and that kind of shows the oil production rates that they have over time. Obviously, 2016 to 2017 was a big one. That's when they acquired Leismer from Statoil. And then basically 35,000, 39,000, 36,000, 32,000, 34,000, 35,000. So basically sustaining production on some of those key assets, right? And forecasting basically for next quarter 35,500 BOEs per day. So that's pretty cool. Niche heavy oil producer evaluated beautifully. Thank you. Taylor Lane, niche heavy oil producer evaluated beautifully. Thank you. Thank you, Taylor. Appreciate it. Yeah, I'll write thank you. Yeah, sorry, I'm a little excited because this is the first time I'm using kind of that interface where on YouTube Live, people can make comments and then I can respond to them. And maybe, if you guys have any like suggestions or something you want to kind of better understand, but I think we did kind of a good job covering the company and what they do. I think like that what drives me really crazy here is that 337 million in cash and the 212 in debt. So they're not like debt free, but they're net cash, right? So that's kind of cool. That but makes you wonder how is this cash going to be utilized? So I don't know. Okay, so let's stop sharing. So the next thing I want to do, okay, let's see what I made in the notes here. Yeah, I want to review Leismer. I want to review Leismer as an asset and kind of go from there. So for Leismer, yeah, maybe we can play this guy a little bit later. Presentations. Sorry, for those of you watching on, listening on Twitter Live, Twitter Spaces, I'm also on YouTube Live at Ticker Razor Oil. So if you just go YouTube Razor Oil, go on there. I don't know. Okay, so this is, guys, this is for me, and I'm going to start from this, is the development of this L8, 82% oil saturation, 35% porosity, 6.2 Darcy per horizontal permeability in X and Y direction, and 4.9 vertical permeability in vertical direction on the gravity drainage. That's Christina Lake type of numbers. Now, the biggest unknown for me here is the heterogeneity. So a Christina Lake type of geology could be like a homogeneous box. It could be like all sand, fully saturated, basically 82% oil saturation, 18% water saturation, but there's no other geologies, like no non-permeable zones, no like inclined heterolithic stratifications, which in short is IHS, which is essentially like low thermal conductivity, like non-permeable regions, where it could limit the growth of the reservoirs. But if the pay, this is the one thing we're going to be looking in this presentation now, if the pay is clean, if the 25.8 meters average pay is clean, this is 1,000 barrels per day wells on a 10 well per pad, which means that out of the 24,000 barrels per day they produce right now at Leismer, at least a third of that production is from that one pad. So this could be a big statement, because if you drill another one of those pads as they design next to it, that's another 10,000 barrels per day. And the decline on that pad is no decline for 5 to 7 years. That's what they're saying, because those are thermal pads. And it kind of makes sense, because you grow by the steam vertically as you reach the overburden, and then grow laterally, and the entire exercise takes place, I would say, maybe 10 years, So, and we can see on some of the other pads the recovery factors, right? So we have pad L7 at 17%, so right here, so fairly young pad, 28% recovery factor, so that's out of 100, right? So there will be like as we can see, there's an area there, and we know the well saturation, so you can kind of understand your cumulative production and how much, if you multiply, let's say, the size of the box times the saturation times the porosity, you can come up with a box, and then you say, okay, I cumulatively recovered, let's say, 1.3 million barrels, and that's 28% of what I'll be recovering. So there's another, let's say, 4 or 5 million barrels to be recovered from this pad. That's kind of at least the way I look at it. Now, another thing we could notice here is that L7, right? Pad 7 has 6 well pairs, and that pad had much longer lateral length in the wells in the way it was designed. So the first pads had 775 meters in length, 700 meters, 900 meters, and now we're going into this 1,250 meter zone. And guess what? They go to L8 and they do the same thing. They have longer wells at 1,250 meters. Now, why would they do it? Like, if they've done L7 before at this really longer wells, and maybe that's the way to mitigate some of the more complicated geology. But at the same time, you don't normally go and do something again if the previous strategy failed. So they didn't go smaller on the length of the well. They went bigger. They went longer. So L8 well length right now is 1,250 meters versus when they initially started 775 meters. So they go longer. This pad is one of the most oil saturated pads at 82%. Porosity, the highest from the least, 35%. Now, porosity, think about this. Porosity is a pure calculation in your oil recovery, kind of not just cumulative production, but what's in the box. Because porosity is literally the liquid that could be stored. So they say within that liquid, there's 82% oil. And the relative permeability, the permeability of that oil, the perm, is 6.2 Darcy. That's Christina Lake type of numbers, right? And net pay 25.8. And so that's why I'm really excited about the upcoming pads and just to see how that's going to unfold. Now, if they're able to do NCG co-injection and treat at the back end, emulsion kind of that they produce, this could get interesting, right? Especially if you spend $56 million producing from 4 additional well pairs. Maybe there's an interesting angle here that they could utilize. Okay, so this is the plan. So this presentation is 2022. It was shared with the regulators, and that's what we're reviewing. So back in 2022, they said, okay, we have approved process capacity to 40,000 barrels per day, but that plan is going to unfold by 2027. And I think maybe the management is a little bit paranoid about kind of oil prices, maybe not being too kind of, being a little bit conservative on the oil fluctuation. So, and that's kind of, for me, that's really the concept of low cost of supply, is that you're not being kind of too greedy, too ambitious. You're basically saying, okay, I'm producing 24,000. I'm going to spend very little to grow to 28,000. And the 40,000 barrels per day, I have the optionality, but I will use that kind of as an option. So they have 8 producing pads, 45 horizontal well pairs, and 15 infills. Those infills, in my mind, this is a very important strategy here. So remember, when it comes to infills, you already have the well pairs. You just land one producer between the well pairs, and that oil is supposedly mobile. So for me, this is like clear water type of economics, because the oil is just kind of flashing comes to you, and there's a certain type curve to it. But this is not a typical SECD operation. Once you put those infills, those are very cheap, kind of low recovery, kind of high netback economics there. So I think there is no coincidence here that they implemented the 15 infills. And I would suspect that all the other like all the other more maturing pads, will see more of that. Okay, you can see the little oil picture here, which is kind of cool. Now, this is what Statoil did for them, right? This is kind of like, there's this concept, kind of know what you own, right? And again, for those of you listening to me on Twitter Spaces, I'm on YouTube Live on your Razor Oil showing some slides. Statoil, that essentially exited this asset, that sold the asset back in 2016 to Athabasca, they basically drill all those exploratory wells, and you can see them in a picture, and tell you exactly what's there. So these guys, like, literally wait, like, their entire job was not to die, basically. All they had to do is survive, not to die, and see kind of, design plans as they were surviving COVID, pay this like significant debt, which they paid about half of it. So they still have debt, like $212 million in debt. This is no joke, but they have a lot of cash, right? 337 million in cash. But at the same time, you could ask, okay, what was the team doing over there for like the past 3-4 years? Well, they were designing L8 and the neighboring pads, I think, because they knew the drainage area, right? They have their lease over there, right? And they have the pad drainage area. They know what's approved. And now they basically have pure map of the cord and image logged wells. Like, that's what you see in purple and blue. And so this is no mistake that they ended up in the L8 area. And that's why in the presentation, they're showing us how they're going to let another pad perpendicular to that. And if that geology is the same as L8, we're going to get another 10,000 barrels per day pad over there. So that's going to be very interesting. Now, I'm not suggesting I know for sure what's going to happen. I'm just kind of speculating. And look at the map. And I think this kind of core here, bottom water thickness map, tells us we know L8 does not have any bottom water, so that's great. So they're essentially kind of deviating from a central asset that they used to have towards a northwest side, and trying to recover like this bitumen in place that you can see on the map with minimal water. But I'm really interested in bitumen in place now. Okay, so this is bitumen in place classification. Okay, guys, look at this. Here we are. Okay, so this is fascinating, right? For those that really into it, Rock, I'm hoping you're watching this on YouTube, because you cannot unsee what you see. So as we look at the core, they have the Wabasca, right? And then they have McMurray. And look at the scale of the depth, right? So they go down in depth. And we get to 389 meters, and that's where we start the McMurray sands, right? So that's where you have the porosity, the well saturation, the perms. And they're showing you the top of the sand, and you can see basically this is where the saturated sand, that's where the oil is. And between that level, so 418 or so to 444, that's about 25 meter pay. It looks fairly clean to me. And pad L8 right there, you can see that similar geology when it comes to kind of thickness of the pay is right adjacent to that pad. So, and you can see why L7 landed where it landed. Now, the CPF, the Central Process Facility on the map, is right there in the east corner. So they actually can kind of have like closer distance towards L5 and L8 than to L7. So I find it fascinating. I think they're going to go and do more of a kind of L8. I think this is kind of what I would have done, but I mean, if they're listening, probably maybe they'll reach out. We'll see. But you want to do more of what works, and that's probably the way to go. Now we can see okay, so check this out, guys. So they give us the regions here on the structural cross sections, right? Pad 1 to 8. And region A, that's where L8 sits. And region B is kind of the central one, right? So A, we get pays of 28 meters, 29, 26, 27, right? And that looks fairly clean to me. That looks like fairly clean sand to me. It doesn't look like too heterogeneous. Maybe like a little bit there at the top, at the A kind of dash section, but 27, 34. So those look like really nice, clean reservoirs. So we'll see, guys. I don't know. And this is the production, right? So when we talk about no decline on the asset, like take a look. So 8 producing pads, so that's up to 2022, 45 SIG developers and 15 infills. And you can see kind of the SOR and oil production rates. Look, it's sustained over time. So that's about 3,000 cubes. To convert to barrels, you multiply by 6.3 to get the barrels. I think today we're at about 24,000, which is the previous peak. But the steam injection rate is declining. And why is that? Because the purple line is increasing. The purple line is gas injection rate. That's NCG co-injection. So that's their ability to pressurize the chambers while reducing the steam requirement. And why would they reduce the steam requirement? Well, first of all, it's good for the environment. But secondly, it gives you the delta to utilize the steam for further oil production, where you can kind of do more with less, in a way, not develop more steam capabilities, but redirect that steam to produce more oil. Because remember, the recovery scheme is really kind of like you have a hockey puck, you steam it, right? Kind of you make the oil slightly less viscous, and then it drains by gravity. So here, they're actually cutting the steam and sustaining oil production, which is what you want to see. You start worrying about assets where steam injection is going infinitely higher, but oil production is sustained or declines. That tells you there are some issues maybe with geology or something that's happening. Now, the well count you can also see over since 2018, 2019 is essentially flat, which kind of tells you that basically it was surviving mode in a way, which kind of tells you that whatever cash flow they were generating up until COVID was probably used to service the debt, right? The significant debt they used to have. But in a way, like if you kind of continue on this path with that new geology from the northwest side coming kind of online, and you're able to have the sweeter spots. I don't know, like I'm not sure if I'm the only one noticing this or other people are seeing that, but in my mind, this is something that, very intriguing for me personally, especially for an asset where you could choose not to spend that capital, where the adjusted funds flow essentially becomes your free cash flow. So this is fascinating. And again, guys, this is like for me, I'm a professional engineer. I'm an award-winning engineer. I have a Technical Achievement Alumni Award from University of Calgary because of my ideas and some inventions. But I really do this for myself, for the community, just to share some ideas about other companies that, that I have a certain view of, that maybe like, do a good job or operate. It's not part of like my work by any means, but it's just something that, I want to float by the community to see what do you guys think? What are some of the things maybe I'm missing in this thesis, right? So maybe something you guys could share as well in the comments. So by the way, I'm gonna take a look at the comments and see what. Okay, so I'll show the comment. Which company are you speaking about? Leismer? Please say name again, please. Oh, the company I'm speaking about is called Athabasca Oil, and the asset is called Leismer. They have assets where they operate. Video is slightly out of focus on YouTube. Sorry, still ATH presentation. Thank you. Yeah, so I think like when you do something live, it kind of gets distorted maybe a little bit. So my apologies for that. But then I noticed once it's recorded and on YouTube, maybe it's a little bit better. So okay, yeah, that's an important one. Like those permeabilities at Christina Lake, guys, very exciting. So non-condensable gas injection. So here, maybe I'll zoom out. So this kind of speaks to the strategy of maintaining the pressure while sustaining oil production, but utilizing that steam for other wells and for other development. Now, if you have more steam capabilities, then good for you. You can, maybe inject more steam, produce more oil, but you don't have that infinite steam, right? And that's kind of the recovery scheme. Like when you do, let's say, for example, when Whitecup taken CO2 from like those coal mines or whatever, right? And they take that CO2 and they inject it in Weyburn, and the CO2 is used to mobilize the oil to be produced. It's called EOR, Enhanced Oil Recovery. You cannot have the effect if you don't have the CO2, right? Let's say you do water polymer flood or something. So you could do like a water flood, or you could do like water polymer flood where the water is much more viscous, or it's kind of more friendly to push things around, I guess. Well, you cannot have that benefit if you don't have the polymer, right? Here, the same concept. Like it's very difficult to recover oil by thermal heat transfer if you don't have the steam. So the idea here is like, okay, we'll pressurize the chambers here and take that steam allocate elsewhere. And I think that's kind of what they're doing here, which is smart. And they talk about disposal water network. So there's no tailing ponds. They think they inject the water to aquifers, so deep underground. And that's kind of what you can see on that map. Okay, so what do I want to do right now? Oh, I want to talk about Hangingstone. I'll present Hangingstone. And maybe next, what I'm going to do, adjust your picture quality, use 720p, and the picture clears up nice. Thanks for that. $720. Thanks for this. Appreciate it. Okay, so now I want to share Hangingstone slide just to kind of tie in Hangingstone presentation. And maybe then on YouTube, I can play kind of what the management team is talking about the company, just kind of to summarize this overall space and get a clean picture, and maybe watch with you guys what was shared on their website kind of publicly. There was some kind of conference and the CEO talked about the company, and maybe that will close the loop on my understanding of what the company does. Okay, 720 high definition. Okay, I hope you can see me better now. I changed it to 720. Let me know. Okay, slides. That sucks, right? Like you do the entire presentation and then people can't even see you. And then I tell you, hey, just change this number on your resolution. And then you look like one of those boomer kind of guys that doesn't know technology. So, okay. So is this Hangingstone? No, this is still Leismer, guys. Okay, maybe I'll just share the CEO kind of conversations there and kind of go from there. What the CEO is saying. Hangingstone. Okay, so let's do a quick Hangingstone and just do what the CEO says. So Hangingstone, again, like minimal amount was spent on that asset, right? Here you can see the picture of the oil. You can see the pads. So we have AAA, AB, CAD, AE. Very limited. You can see the huge lease, right? Like huge lease in the picture. Let's see if people can see it, okay? I'm referring to the viewers. Oh, okay. So she was talking about the viewers that can see me. So the viewers, I'm referring to the viewers, and what she says is, or he says, adjust your picture quality to 720. Thank you. Thank you for that. Okay, so look at the development area in pink. Like it's huge, right? But then you have that red line, I think maybe it's the lease area. So they basically didn't even like tap into like the resource. I think there's like something like 25 years there of recovery, but they didn't really spend any money on this asset, right? You can start seeing through the core that the geology is not as nice. and there's like different like pockets of bottom water, some mud channels here, so it's a little bit more challenging. It's a little bit more challenging asset. Like look at the pay, right? So when we look at Leismer, the pay looked a little bit different. Here the gross pay is very high, but the kind of the sand, the saturation, the permeability may be a little bit worse. And you can see kind of the reservoir criteria that they specify. So breccia, sand, sandy IHS. IHS stands for inclined petrolithic stratification. So that would be basically non-permeable layers. They kind of like they look like kind of almost angled non-permeable layers. They have very small heat thermal conductivity, so it's very difficult to drain oil through those layers. And you can have not only sandy IHSs where you have those like kind of crappy geologies, you can have muddy IHSs as well, where they kind of like muddy and like look like mud, like actual like gray mud, and very low thermal conductivity. So they're like the worst, right? Or you can have mud where there's like minimal permeability. So here, really nice pay. I mean, like think about this. Like here, I'll zoom into that. Like, what if you had Leismer type of like oil saturations, permeabilities in the 40-meter pay like we have here, right? So it's too bad, but what can you do? This is the concept of geology, and I think that's why I'm a little bit passionate about this. And sometimes on Twitter, I'll post stuff about like when, let's say, in conventional, you mix. Let's say you take a glass of water and you mix it with oil, like olive oil or whatever. The olive oil will float on the water, right? Well, same stuff happens in nature over millions and millions of years, where if it's heavier oil, it will migrate downwards. At the bottom water could be like at the bottom. You can have scenarios where oil is heavier, so that it will be on top. You can have pockets of top gas. Those geologies could be very heterogeneous, right? So for us, like United States will produce like only 2% of the heaviest oil, or heavy oil. We produce like the heaviest of the heaviest oil in Canada, in this company as well, Athabasca, right? So we'll produce bitumen. So those will be the kind of kerosenes, the shingles, the asphalts, the heaviest products of the products. The statement I like to make is that it's very difficult, to do shingles with propane, right? With barbecue propane, because it's just not applicable. You cannot put like a roof out of barbecue propane. It doesn't make any sense. You need like almost like a plasticky material which comes from heavier oils. So essentially you have a geology that's a little bit more crappier here, but nevertheless, look at the graph, look at the production. Let's not have biases. Let's look. So the SOR is a little bit higher here, right? So, but through in situ injection, the acid improved tremendously, right? Going from SOR 5 to SOR 3. But look at the oil rate, right? So they literally shut in production. Here, I'll zoom in a little bit more. During COVID, and they restore production and go back to kind of previous rates, and obviously declines, but not declines because there was so much money invested. Like there was no money invested in the asset, very little. And so I think it kind of speaks to like what happens when you do invest a little bit money and you are surviving in a zone where you kind of co-injecting NCG, as you can see with the purple line, maybe cutting your steam injection, maybe developing another well pair. Are you able to go back to those like 1,500 cubes a day, which is maybe 10,000 barrels per day type of rates? And the netbacks, I think they were like closer to $40, right? Again, this is not ideal asset, but it's there, it's kind of, it competes, it's not a total dog, I think. So kind of makes sense to me. And again, I don't want to kind of get repetitive, and I'm sure I am, but Leismer is kind of the jewel. Hangingstone is there. You have this another 2,000 barrels per day in Kaybob, right? Kaybob Duvernay. And they just monetized 3,000 barrel per day conventional, selling for $160 million. And so, there could be some value here. Okay, so let's recall the numbers we saw in Leismer and look at the geology numbers here. So again, 5 well pairs for each of the pads. Okay, now start seeing, like, look at the lateral length. It's not 1,250, it's about 800, 600, right? So it's a little bit cheaper. Well saturation 73. Okay, so within all of those IHSs, mods, all that, you have about 73 oil saturation. Porosity 34, so not bad. Permeability is about 5. 5.3 on one of the pads, but it could be as low as 4.5. So that's not a 6, right? 6 is really nice. This is a little bit lower. And relative, not relative, permeability in the vertical direction is 3.7. So again, this is like a steam-assisted gravity drainage, and your vertical permeability is in the 3s. So that's not super ideal. Net pay is 25, 29, 25, right? We did see like higher pace of about 40 meters, but I guess maybe the cutoff for that steam chamber, as it's being accounted for, like for what you're going to recover, it maybe does not account for some of those non-permeable zones because they don't allow like drainage, right? Because those are like inclined strata, the muddy zones. Maybe you can't drain through them, which makes sense. Now take a look at the recovery factor. So this asset been operating for I don't know, maybe like what's the production rate here? Yeah, January 2015, right? So 9 years or so, 9 years. The recovery factor on those pads is 15%, 33, 13, 18, and 18 for the 5 pads. So there's a lot of room here to just kind of kick the can down the road, NCG that thing, let it kind of go, collect your whatever $40 and put some infills, optimize this thing, minimal expenditure, and just let it ride. Just let it ride as you do the Leismer, and I think that's the way to go about this. Okay, summary. NCG co-injection has been expanded across all pads. I think it's smart. It's just good. It's just good for business. What else they got here? Oh, it's just more for the regulators. How much you can see the oil rates, right, in cubes. So to convert this to cubes, you have to multiply by 6.3. So, and you can see kind of what the asset is designed for. It's designed for what, 12,000 barrels a day or so, something like that, 13 maybe. And they've been kind of around at 1,400 cubes a day. Yeah, maybe there's an opportunity here. I'm not totally giving up on Hangingstone, but obviously that's the key about this company. You have various optionalities, and the question is, what is management going to do? How are they going to allocate that cash, right? So that's going to be key. Okay, so I'll stop the screen here. So the next thing I'm going to do, I'm probably going to finish the Twitter space here. So thanks guys for watching. And what I'm going to do, I'm going to go and play the interview with the CEO on YouTube Live. And he's going to tell us like what their plans are and what they expect to do. This was from 27th Annual Energy Conference in Peterson Co., and it's in the public domain, shared on Athabasca's website. And just so I don't kind of, obviously I'm not speaking on their behalf by any means. I'm just a dude like on Twitter trying to do due diligence, trying to understand the company, go through the Q3 numbers. I want to kind of better understand and maybe discuss some of the comments, make some notes here. But in overall, like if I was to make a summary oh, thanks, Razor. Oh, yeah, thank you. If I was to make a summary, right? So we're talking about a $2.3 billion company producing roughly 35,000 barrels a day. They just reported Q3 generated 108 million in free cash flow. Again, if you kind of looking at the yield here, if every quarter was like Q3, that you'll have 400, let's say, million in free cash flow. But we know it's not. We know it's not. So you have $2 billion company, about 20% yield. But reality is, I think it's between 10 to maybe 15, maybe 15 to 20. And it depends how far we're going to go into kind of that cycle. If the oil price is going to sustain here and be like in the 80, 85, you should probably expect more of those type of numbers. If we're going to go maybe a little bit lower here, you should expect maybe 30 to 50 million in free cash flow every quarter. Debt, 212 million, right? People say that there is no debt. There is debt. There is debt. We cannot deny it. But there's 337 million in cash. So what are they going to do with cash? We know they can use 56 million to produce 4,000 barrels per day additional in Leismer, which is, for me, it's a no-brainer. That's going to happen. They must do this. It just makes sense. So if management announces we're going to spend 40,000 per flowing, advancing 4,000 barrels per day in Leismer, getting the asset to 28,000 barrels per day. I'm happy about this. Makes sense. So on sales, they had 380 million in sales in the quarter, which is great. Adjusted funds flow, 140 million. So if you generate close to 110 million in free cash flow and adjusted funds flow is 140, the sustaining capital is 30 million, which is very small for this type of company. And obviously, they divested the asset for 160 million. I wonder what's going to happen with the other conventional assets, and I wonder what's going to happen with Hangingstone. Like Hangingstone right now is a decent asset. It's not a dog like people say, but it's there. It's not like amazing, but it's making money and they're generating cash flow. So that's all you can ask for. Okay, so that's my quick summary to that. Right now, I'm gonna share that video with the CEO and go from there. All right, so share. So you guys should be able to see on YouTube right now. I've been talking about this company now for 2 hours and 1 hour 56 minutes, and my plan is to do this about like every company that reported Q3 in the Canadian sector, which is like, I don't know, 50 companies. So that's going to be like 100 hours of me sitting here. So I need to like question what do I do with my life and if it's a good use of my time. But hopefully you guys kind of like it and appreciate that. So anyway, I'm gonna kill the space here and just play that YouTube thing, and maybe we'll connect with some of you a little bit later. So thank you all for listening. Okay, so I'm only with the Peter. I'm only with the people here on not on Twitter anymore. I'm only with people on YouTube Live. And what I'm gonna do now, I'm just gonna play this.
Pleased to have our next session here. We have Rob Broen from Athabasca, President and CEO.
Hear it.
Maybe pass it over to you for a few remarks, and we'll go into questions from there. So thanks for coming.
Can you post me in the message if you can hear it? Okay.
Having us here to Peters. Maybe I'll just give you a 2-minute overview of Athabasca.
Hey John, can you hear it?
About a 35,000 barrel a day company. We are oil sands weighted. So I think what differentiates us is a very stable production profile. We have about a 5% production decline and a very, very big reserve base, probably in the order of 80 to 100 years of reserve life. And we're oil weighted. We also have a light oil portfolio, and we're really focused on the Duvernay now is what we are. And but our production is about 85% oil sands weighted. Just quickly on our balance sheet, end of Q2, we had a net debt position of $62 million and lots of liquidity, 220 million, including 135 cash. That is about to change significantly. We announced we did a transaction here recently where we sold some non-core Montney production, and that was about $160 million. So as of the end of this week, we'll close on Thursday. Our net cash position will be in the order of $125 million plus. We'll have liquidity of over 400 million and cash position of over 300 million. So very robust balance sheet. We've worked really hard to get there and focused on that. We do have some growth built in. We're growing our production by 5 to 7% per year over the next 3 years, primarily through our Leismer asset, which I'm sure we'll talk about. And we have been doing significant buybacks as well. So this year we've allocated 75% of our excess cash flow. And since mid-April, we've bought back about $72 million worth of shares. Average price is $3.16 end of August. So it's been a pretty good return for our shareholders. So that's probably the snapshot I would give, Tyler.
Sure. I mean, the first, it seems like most logical question is obviously Athabasca's financial position has changed a lot over the years for the better. So now, as you're sitting here with net cash as at the end of this week, how does that change things for Athabasca as you look into 2024? Stuff like the 75% free cash flow payout, does that potentially even get bigger? Will you do something bigger on shareholder returns, or how does it change things for the company?
Yeah, I mean, it's good to have options. And we've worked really hard to get our balance sheet to where it is. I think most companies that you'll see here have, but we were really focused on getting our debt position down. And so that allowed us, given the free cash flow profile, is to do other things. So We are very focused on cash flow per share growth, and it was very clear to us that the best thing we could do in 2023 was buy back our own stock. We see the cash flow inflection that's coming in 2024 and beyond, and you know, the best thing we can do is invest in ourselves, and that's turned out to be true so far. Yeah, so having a good balance sheet is good. It allows you to withstand volatility, but it also gives you
Invest
options.
in
We have
ourselves,
no
guys.
shortage of things we can do in our portfolio. Leismer is a very big asset. We have regulatory approval to do more there, and we have a big portfolio in light oil. So, you know, we'll see when we go forward. In terms of what we're going to do with that cash, we're very committed to 75% for 2023. I'm sure there will be a component beyond that as well. When I say excess cash flow, it's funds flow minus sustaining capital. And for us, sustaining capital is very low. So for this year, it's $125 million on a 35,000 barrel a day asset base. So yeah, that's where we're at.
Yeah, I think we nailed the coverage for this company, guys.
You mentioned on Leismer, it's your most material asset by far. Can you just go through the various stepping stones on when the next growth is going to come through? And then it's looking beyond that. You talked about the potential going to 40,000 barrels a day eventually. Can you just kind of walk through what's the what's in the plans already, and then what should investors be looking?
Let's see what he says about 40,000 barrels per day on Leismer. Yeah.
Yeah, sure. Happy to. So Leismer is our cornerstone asset. We entered the year about 20,000 barrels a day on that asset. We embarked on an expansion program to 28,000 barrels a day. We had already drilled some wells last year that were going to get us partway there. We said we would exit this year at 24,000 barrels a day. We're comfortably through that already. We're over 24,000 barrels a day for the month of August. So obviously the wells are performing extremely well. We're ahead of schedule on that. And then we are doing a slight plant expansion. We're increasing the oil treating capacity, and that will get us to the 28,000 barrels a day by mid-year next year. We've already drilled an additional 4 well pairs and 4 infill wells on the asset, and that's inventory that will get us to that 28,000 barrels a day next year. Going forward, Leismer is unique in that it has a regulatory approval for 40,000 barrels a day. And so this expansion to 28,000 is about a 14,000 per flowing barrel capital efficiency. We think we can go to 40,000 barrels a day for probably somewhere in the mid-20s, 20,000 per flowing barrel.
Yeah, that's a big one. That's a big one. 20,000 per flowing on 40,000 barrels per
We're
day.
doing all the operational work to be ready for it. I think very important to us is to protect our balance sheet, protect our returns to shareholders, and make sure volatility is out of the differential. And then we'll probably be looking at that next.
So I know that investors want everything between growth, shareholder returns, all those things. What's the latest, like when you go through the potential to build a project like this, what's the type of discussions or feedback that you get from investors on doing something like the Leismer bigger expansion to 40,000?
Yeah, you know, it's hard to be everything to everybody, right, when you're 35,000 barrels a day. So we were very focused first on delevering the balance sheet, and that was, I mean, shareholders are very supportive in that. We're largely there, like we've delevered where we need to be, and we've got better things to do than buy back more debt. And shareholders have been very supportive of because they also are starting to see the 2024 cash flow profile. And so we're pretty focused on the cash flow per share metric. So if you're growing your cash flow and taking your share count down, you get that exponential value for shareholders. So we saw the value in share buybacks. As far as growth, it's well within our means to grow Leismer to 40,000 barrels a day and have a return to shareholders, depending on your commodity price profile you're looking at. And I would say the only thing is we'd like to see any potential volatility and differential go down, and that comes with egress out of Canada. And you know, recently we've seen some headlines on TMX might be delayed a little bit. We don't know. There's good egress right now. We'll have more certainty by the end of this year. So as far as shareholders, I think there's been very good support as they're seeing us generate the cash flow, seeing the clarity that we're not just talking about it, we're actually delivering it, and that we have the ability to do both of those things. I will say, and you'll probably ask me about the Duvernay, but I do see us allocating some capital to Duvernay as well. We like it. We think it's a top play in North America. We have a big position in it. We've got a partner there, but I see us allocating some more capital there.
Can you give any more specifics on that? I know maybe a month or two ago we saw Athabasca licensed some wells. Earlier this week, we saw Murphy license some wells.
Yeah.
So when you go through the, the $145 million that Athabasca's spending this year, what's kind of the right trajectory as you look into 24 on what that potentially looks like?
Well, I think naturally, so this year was a heavier spend on Leismer with the expansion. That starts to come off next year, and it's back to sustaining capital if we don't do any kind of expansion. So what we'll do is we'll increase our spending on the Duvernay. And the Duvernay, look, there's been 1,000 wells drilled in the Duvernay now. We're predominantly in the oil window, which is where we want to be. It's a nice natural hedge with condensate production with our thermal oil production. The type curves are very well established. It's a very active area. We're very right next door to Paramount and to Crescent Point and also to Chevron. So the way we have our partnership is we establish a budget and a 5-year plan. And if there's any disagreement on that, you just defer back to the 5-year plan. And because the approved 5-year plan is pretty low production spend, it gives us in the position of really being able to control the spend and control how much we want to invest in it. So our intention is to spend more. And so you can see, at least the partnership doing at least 5 well pairs next year and potentially more depending on where we push that. So, yeah.
Can you just remind everyone on the timing of when does the annual kind of budget get set within the partnership between yourself and Murphy, or how does that?
I mean, the discussions start mid-October and it's finalized early December. So, we'll be out in December with our final budget, but I wouldn't be surprised. I guess don't be surprised to see some activity even ahead of that commence.
And then I guess as you look at some of the various things you talked about between growing in the Duvernay, growing in an asset like Leismer, is anything new to say on hedging into next year? We got the forward curve at over $80 WTI. We're still waiting for heavy diffs to tighten. I know that's not that liquid, but is there a point where Athabasca starts layering some hedges, even though you don't need to from a balance sheet standpoint?
Yeah, I think we're hedging 25% of our production right now. What we're putting in is very wide collars. So we establish a floor price that we think we're, protecting our capital program and our intention, on return of capital to shareholders. So right now we've put in $50 floors. By the upper end is pushing $100. So that gives us basically complete exposure to commodity prices. I don't think investors are looking for us to speculate on oil. I think they're looking for us to protect what we have, and they invest in us because they see the torque on oil. And $5 move in WTI or WCS is $80 million cash flow, and similarly on WTI, $5 is $50 million cash flow. So we're one of the torquiest names out there with a very clean balance sheet. So when you have a clean balance sheet, you don't have to take the big insurance policies on hedging either. So.
And so is that still the framework going forward? Is that you kind of consistently target to hedge 25% of volumes, but with big collars?
We like that profile for us, where our balance sheet is. So I think you could expect to see us do that. We do. I mean, our debt, what we have left for debt requires us to hedge 25%, but it's very, flexible in terms of the type of hedges that we put in, and that's what we've chosen. Yeah.
And then I know within, we're still going to hit some different topics here, but outside of Leismer and the oil sands, you still have some of the, what we would say one of the best undeveloped projects in Corner. Are there scenarios where either that gets pushed forward? Is there some way that Athabasca can unlock value related to that asset? Or just give any perspectives that you have on that?
Well, Corner is a unique asset. It is also an asset that we acquired from Statoil. It is completely de-risked. There's over 300 penetrations in the reservoir on that asset. In fact, there's observation wells already drilled into it. We know exactly what we have, and it's a big resource. There's a 1.5 billion barrels in place, and 2P and 2C resources. I think it's between 800 and 900 million barrels. So nobody has an asset like that outside of super majors. So it's right on the pipeline corridor, and it has a regulatory approval for 40,000 barrels a day because it's tied to Leismer. So it will take a big chunk of capital. I think the first phase is probably $750 to $1 billion, and to get your first 20 or 25,000 barrels a day. I think it looks really compelling at today's oil prices. I think we'll have to fund it outside of our existing cash flow and balance sheet, but I think there's going to be ways to do that. So it's pretty exciting. I'm not sure shareholders give us value for that. Sanction to first steam would be about 36 months on that project. So a little longer cycle time, but huge reserves and a brick of production on cash flow. So that's what we like, and it fits well with us.
And so just kind of shifting back to some of the more defined growth that you have on something like Leismer. So, if the target is to get to the 28,000 by, call it, middle of next year, when would a potential decision be made on growing it further to the 40,000? Because could we be sitting here at this time next year talking about a 40,000 FID is on the cusp of happening, or is that almost a little too soon for people to have in their head?
If oil is $90 a barrel and a $12 differential and TMX is running, we will not be having this conversation because it will already be sanctioned. I guess is the way I put it. But, we made an assumption of a $12.50 differential going forward once TMX is on, and I think that's defendable and reasonable. But it's not on yet. So let's take it a step at a time. We're very constructive on oil prices, and we've been very careful to protect the company through our strength in our balance sheet.
And then how long would that type of expansion take from the time to sanction to when it starts doing first steam or ramping up? Is that a 1 year lead time or 2 year lead time going from, say, the 28 to the 40?
If we were to sanction at the end of this year, you would see oil in 2026. So, if you look at our profile, we're going to be growing right through to 28 by mid next year. 2026 is not that far away beyond that. So, we like kind of that step change. And the other thing with Leismer that some people don't know is through the downturn, we actually bought some of the big pieces of equipment that you need for that expansion. So we have 2 brand new steam generators sitting on our site. And the reason we have those is because when Shell exited the oil sands, they canceled the project that had 2 bolt-up steam generators. We got them for pennies on the dollar. So they're sitting on our site. They're brand new. They're ready. So they de-risk not only cost, but schedule, right? So we feel pretty confident in our ability to execute very efficiently on that.
And I want to make sure I didn't mishear anything. You said if you were to sanction it at the end of this year, it would be on at
2026, yeah.
Okay. So is that a potential thing that people should look for?
I'm really trying hard not to set expectations on that, because I think what I want people to be more, I guess, focused on is that we're protecting the financial position of the company, and we've worked really hard. We're not going to sacrifice that. So we're looking for certainty in cash flow, which I think we're going to have, and that will position us to be able to sanction it. But return of capital to shareholders has been very important this year. We're not going to sacrifice that either. So it's a step at a time. But sitting here with the opportunities that we have for growth that are very capital efficient and return of capital to shareholders with a clean balance sheet is a really good spot to be in. So, yeah.
So when you go through the think back to Athabasca over the last 10 years or so, and you go through something like the Montney that's now been kind of divested. When you look at Athabasca today, the assets it have, we kind of went through this potential growth that exists across its portfolio. Is there anything left that's kind of non-core sitting within Athabasca, or is it to the point where everything's cored up and it's just a matter of driving some potential organic growth across stuff like the Duvernay and Leismer?
Well, I think we're very happy with our portfolio. We don't think we have holes in it. We've got a deep inventory in thermal, and we have a deep inventory in Duvernay assets. So I think we're pretty focused, and the combination of some really high returning short cycle time assets, along with our, these bricks of production that you get and stability with thermal, is a really good combination. So I think that provides clarity. I think you will see in the coming year, we'll provide more clarity on the value of our Duvernay and how that adds value to the company. So look for that. We have other assets in oil sands and stuff that are way longer term, and frankly, we don't talk about them very much. So that's the status of our portfolio. And the Montney, I should just clarify. I mean, we sold that. It's relatively small for us. It was not competing for capital. So I would put it in the category of non-strategic. We were able to sell an asset that's producing about 2,500 barrels a day for $160 million. on a strip prices, that's an 8 times multiple. Like that was a fantastic metric and shored up our balance sheet and allowed us to focus more on a better returning Duvernay and Leismer.
So I guess one other asset we haven't touched on yet is just on Hangingstone. Anything to speak to there in terms of just anything as you look into 24 and 25, just thinking about drilling sustaining pads, anything like that, anything changing on that asset?
Yeah, so Hangingstone was the original Athabasca asset, came on stream in 2015. It's doing about 7,500 barrels a day. Our plan is to basically hold production. We haven't invested capital there since 2015. So, I mean, that tells you kind of the nature of an asset like that. You really don't have to invest capital. And it's a little higher cost structure. We've got the SOR down. We've put a truck terminal in that's really helped lower our operating costs, brought us some operating income. And we likely will drill a couple of sustaining well pairs this coming winter to hold production where it's at, and intend for it just to be a cash cow for the company, but it's not a growth asset.
So this big picture, when you look at the overall CapEx from this year, roughly 125 million of sustaining capital, is that number kind of gradually, what would be the potential rate of change as you look into 24? Does it hold around that level, or does it increase a bit just because of general inflationary pressures and something like the Duvernay is potentially starting to grow again? Just what should investors have in their head for how sustaining capital changes?
So it grows modestly because you have a bigger production base that you're maintaining, and there is some inflation. So once we hit 28,000 at Leismer, I would say our sustaining capital is probably more like 150 instead of 125 million. And then anything above that would be growth capital. So there will be some growth capital next year, and that'll be primarily Duvernay focused.
Okay, thanks. I see we're running, probably have half a minute left. I mean, I'm just going to circle back on some of the shareholder return stuff is some of the probably most interesting things happening within Athabasca. So what are the scenarios where you don't buy back 10% of your stock over the next year? Feels automatic to me when you go through all the numbers.
Yeah, I mean, we will fully execute this NCIB, and in fact, we'll probably be ahead of the timeline on it. I can see us renewing that and continuing to buy back our stock. I mean, the cash flow inflection for us in 2024 through production growth and also a differential that will narrow eventually is big, and that's pretty unique, for our company. So buying back our shares to see. We think our valuation will compress, and that will generate a lot of potential upside in our share price. So we're mechanical about it. We're not trying to speculate. We just think it's good value investing in our company because we believe in it, and that will continue.
Okay, great. We're over time. I think that was a good way to end it. Thanks for doing this.
Thanks.
Okay.
All right, friends. Well, I think we covered most of it, and obviously with the CEO, you saw some comments here, and I think they were pretty representative of what we talked about. Obviously, he's been very careful about not promising, not saying we're going to develop corner, we're going to, do this and that. But what he's saying, like, we're going to take it step by step, see where the oil price is at, which I think it's a great idea because you really don't want to kind of make too many assumptions when it comes to kind of where the oil rate is going to be. One interesting comment I think he made is that if oil price is 90 and differential is about $12.50, then there'll be no doubt that I think kind of the Leismer expansion takes place to 40,000 barrels per day. I think one of the big benefits for me personally from this space that I made, what I learned is that there was one piece I missed, and I learned this in the space in this video right now. And that piece of information is that the estimated kind of spend to go from 48,000 barrels per day, 24,000 barrels per day to 28,000 barrels per day is, I think it was about 8,000 per flowing. Where if you go from 28,000 barrels per day to 40,000 barrels per day, is about 20,000 per flowing. But the incremental number is essentially 12,000 barrels per day because now you increase from 28. And if I do this math, so $20,000 per barrel on 12,000 additional barrels in Leismer, that's $250 million, right? That's $250 million. But that plan is kind of, if that what's going to happen, then we're looking at, a situation here where a lot of that cash that they have could be used for that purpose. But what's unique about this is that, think about MEG, right? So MEG is 100,000 barrels per day, 8.5 billion dollars in enterprise value. So if that trades at like maybe discount to MEG at, let's say, 70,000 per fly, not 80,000, 70,000, and it produced 40,000 barrels per day, well, that's $2.8 billion asset value just for that, which makes this company over $3 billion in enterprise value. And now it trades at like 2.3, 2.4. So there's at least 20-30% of appreciation here for the next couple of years if they choose to do that plan. So something to think about, something to kind of think about a scenario here on how some of that cash could be utilized. But at the same time, if the stock drops, let's say, or just kind of go sideways here, they can do this NCIB and buy back shares and be fine. What's really interesting about the CEO comments is that he's basically saying we're going to take it step by step. We're evaluating plans. And so if I was to summarize all of that space, it's like almost 2.5 hours of talking about Athabasca. In my mind is that there's lots of optionality, which also means there's lots of opportunity here for management to win big, but also potentially disappoint. Because if they make the wrong decision, maybe, the market may not be happy with them. And so I hope they make, smart decisions. What really helps is that last quarter, $108 million was generated in free cash flow. And so if you think about this, if they can do it like every quarter, they're probably not going to, but if they could do it every quarter, with this kind of have cash being generated towards that growth opportunity to get that asset to 40,000 barrels per day, and we're talking about Leismer. One thing that there was no doubt about is that Hangingstone is exactly what I described. It's going to be at maybe 7,500 to maybe 9,000 barrels a day, just sustained, just put extra wells, steam those wells, just over time, get your whatever, that $40 net back, just keep going with it, no big deal. If somebody wants to buy it, just sell it, everything's good. The Kaybob Duvernay was really interesting. He shared that maybe they're going to use some of that capital, if they don't use it at Leismer, to grow. And then we know how that worked out in the Montney, where I think he said for 2,500 barrels a day, I think it was closer to 3,000 barrels a day, but he said 2,500. They generated 160 million in cash that now they have in the books. So very exciting, lots of optionalities here. So first of all, just wanted to thank everyone. I know 2.5 hours isn't much, but I think it's holistically really covers the topic. And thanks for the viewers that watched live. Thanks to the listeners on Twitter Spaces. Really appreciate everything. I hope to do a little bit more of that because, like I said, it kind of forces me to sit here, talk about oil, talk about these companies, really make my own decisions to how to allocate kind of my investments. But of course, none of it is investment advice. It's more aggregation of data to tell the story associated with that company, so then people can decide for themselves if this is something maybe they understand a little bit better, maybe they could consider as an investment, or maybe just for learning as a kind of holistically speaking, for educate themselves about the sector and where companies stand. So thank you all so much for watching. I'm gonna end the stream, so all the best. Thanks, guys.